This is the Asia Trade. I'm Paul Allen in Sydney, where the markets just opened.
I'm Haidi Stroud-Watts. The top stories this hour. Asian stocks are set for gains after a rotation out of tech megacaps and Wall Street higher. Markets are awaiting a briefing from Beijing on support for China's housing sector. Investors will be watching TSMC's earnings today for fresh signals on AI-driven chip demand. We'll also be speaking exclusively to AMD's CTO. Plus, Stanley Druckenmiller tells Bloomberg markets are convinced about a Trump election victory, but he won't be voting for either major party candidate.
Right, let's take a look at how we closed in the US. Pretty good day, really. Modest gains there. Financials performing pretty well. Morgan Stanley was up almost the most in 4 years. Small caps surging as well, and tech put in something of a recovery also. The real action was with small caps up about 1.6%. Now, in terms of where we go from here, we've heard from the Goldman Sachs trading desk. It sees more upside to the S&P. Got a target of 6,270 by year end, and this is based on data that crunched going back all the way to 1928. Found that typically in an election year between mid-October and the end of the year, you might see a rise of up to 7%. Now, speaking of elections, we've been hearing from Stan Druckenmiller, as we mentioned there. He says the market's already made up its mind who's going to win.
I remember how right the market was on Ronald Reagan in 1980, despite what the pundits were saying. And I must say, in the last 12 days, the market and the inside of the market is very convinced Trump is going to win. You can see it in the bank stocks, you can see it in crypto.
We'll take a look at how we're setting up when it comes to the Asia Open. We are looking like gains, given that even with that rotation away from mega caps, we saw small caps really taking the spotlight in the US session. But early gains expected here in Asia. That rotation we could see as well when it comes to some more potential weakness out of tech today. Watching China as well, that index of US listed Chinese companies rising about 1% on Wednesday. When it comes to what we're watching for Japan, stocks in the previous session did see that decline. Some of those chip-related firms seeing particular weakness. We also saw Australia falling from record highs with some of the weakness from those miners as well as financials as well. And watching the Aussie dollar, we have SocGen saying that this China proxy is the most at risk in a Trump victory. They say that the Aussie will fall the most out of G10 currencies if we see another Trump administration, really recommending a trio of options trades to hedge that risk. And of course, that potential exposure to China and more tariffs is really what's weighing here. But we are also, of course, firmly focused on China with this expectation of another briefing that could bring more support for the property sector. Let's bring Tony Sycamore, who's a market analyst at IG Australia here in Sydney. Tony, really great to have you with us, I should say. So which sort of team are you on when it comes to China? Are you still waiting and seeing, or are you really encouraged by what we've gotten so far?
Very much well the latter. I think the dovish pivot, which we saw at the end of September, the monetary policy easing, it's a very good sign that more is coming. And I think we all recognise that monetary stimulus needs to be supplemented by fiscal stimulus, and we're still waiting for firm details around that fiscal stimulus. So I suspect it probably comes towards the end of this month when we have the NPC Standing Committee. And in the interim, I think we just need to hold the line. We should be looking to be moderately long China stocks and looking to add if that stimulus meets or exceeds expectations.
The wild swings are, of course, what has always characterised Chinese stock markets, right? Does that undermine the ability for foreign investors to get in there? Do you prefer exposure through Australian proxies, for example, or you want to be directly in that given how much valuations have fallen?
It's a great question. I mean, the moment that I saw the stimulus announced in late September, the first thing I did was look at Fortescue because it had fallen so significantly, but I also looked at the Hang Seng. So to me, that's probably where we're happy to be, looking at probably some of the Australian proxies and also looking at the Hang Seng, which offers
but
obviously...
not onshore? Not
onshore at this point of time, no. I think the idea is that we want to be nimble, we want to be able to get easy accessibility, because these headlines which continue to come out are driving volatility, as you mentioned.
Got a lot of data coming out of China in the next few days. GDP, industrial production, retail sales. I mean, all of this, of course, predates the signal that we've had from the Chinese government. To what degree do you think that just announcement of stimulus is going to be enough to head off any adverse market reaction if that data's really bad?
Well, I think we are going to take a view that it is a little bit backward looking, and that the market's still taking a more optimistic view that stimulus is coming. I think we know that China has been in a slump. 15 months of property declines certainly be concerning. I think we just need to try and be mindful that data is backward looking. They've already taken steps, as we mentioned in early September, and I think more is coming. I will also hasten, there is others out there which think that there isn't that stimulus coming. When I look at a stock like Mineral Resources, a big stock on the ASX 200, there's still a very hefty short holding there on the register. So there is some which are taking the opposite view, but for me it is that it is coming, that it was pretty pointless to go out there and ease monetary policy without providing that fiscal stimulus as well.
How about the potential impact to Chinese assets from the US election, be it either a Trump or a Harris win?
You know, that's where it gets interesting. And I noticed you mentioned Stanley Druckenmiller's comments this morning, but you can see by the way that the US dollar has rallied over the last 2 weeks, you can see by Bitcoin trading at highs we haven't seen for quite some time. Obviously, equity is very firm. It does seem that the markets are now pricing in that Trump victory to a certain degree. And what that means for Chinese stocks, well, again, it's probably not the best thing because we know that the tariffs are going to come. Whether it's as high as that 60%, which he's alluded to, remains to be seen. But certainly, I think there is going to be some tariffs, and that brings the risks of those retaliatory tariffs and also a trade war. So that's another headwind which potentially China has to get through as well.
We were talking earlier, the last time you were on with us was it was an interesting day in early August, right? What we saw happen with the huge sell-off in Japanese assets. Have you sort of repositioned since then, or are you still quite constructive on Japan?
It was funny as we were chatting. It was the Nikkei was down 5% when I was last chatting, and by the time I'd finished the interview, it was down closer to 15%. So it was an extraordinary day, and I think we've probably looked past some of that volatility, given the rhetoric from the BOJ has been more dovish since that point of time. But I think given the corporate reform, the macro outlook, which is there in Japan, expected to drive earnings, plus that strength from the yen has now receded, and the BOJ has also stepped back a little bit from that hawkish rhetoric, I think the Nikkei is still a great place to be. Given the fact we are expecting volatility, I wouldn't be chasing it above 40,000 at this point of time. Probably more inclined to buy dips back towards 37,500, looking for a rally up towards 42,000.
Notwithstanding the previous session, of course, as we see that rotation out, investors are still looking for opportunities and looking for excuses to get back into US megatech, right? Mega cap and big tech. Do you think that's sort of a result of the Fed kind of just coasting along and the macroeconomy still looking pretty good?
I think that, I mean, it's interesting. We've seen the run by the Dow Jones and the S&P making fresh all-time highs, but the Nasdaq, the tech-heavy Nasdaq's actually been lagging. So I think that's probably an opportunity because I think coming up to the earnings reports we're due to get shortly, I think they're going to probably meet and jump over a very high bar. So I like the fact that there's potentially an opportunity there. Of course, the news that we got earlier this week about the Trump administration potentially looking to limit exports to certain countries, that was a little bit of a shot across the bow. Potentially we're just seeing the first stage of more or stricter export controls, if you like. But broadly speaking, I think that the AI trend is still very early on, and it's just going to continue to transform the way we work and live. And I think it's a great opportunity. I think that Nasdaq will push to new highs as well.
In terms of support from monetary policy, I know that you think we're going to see total about 100 basis points of easing from the Fed. How much of that do you think is priced in so far?
I think it's pretty much all priced in now. I think that's something whereby we started the year, I remember the first time I came on here, there were 6 rate cuts priced, and then it swung back to 2. And I think probably there was probably a medium path, and that's what we seem to have found. We've got the 50 basis points September. I think we get another 25 in November and another 25 in December. So to me, it's priced. The Fed's been pretty accurate in terms of its guidance. It's pushed back against both extremes. And here we are. I think we're now probably right where they want to be coming into year end.
We've talked a bit about Trump and, you know, we're inching closer to November, but how sort of reactive do you see global investors really being to geopolitics? Because we've seen the situation in the Middle East, you know, multiple wars now on foot and, you know, more or less a shrug outside of energy markets.
It's noise, isn't it? I mean, I've made the point that we've got the regional bank index this morning back to its highest level since March 2023, which is the banking crisis. It gobbled up one of the mega banks. Credit Suisse is no longer with us. But it shows how frantic and how high-speed markets are. We get past these inflection points relatively easily, providing the right backdrop is in place, and we do have the right backdrop in place, at least in the very early instances of the new administration, whoever that may be. So providing that sort of plays out, I think we can, you know, as you mentioned, crude oil, here we are, we're lower than we were after the October 7 Hamas attacks. So all things being equal, these shocks, this uncertainty, once it passes, those macro trends tend to dominate.
All right, Tony Sycamore, market analyst at IG Australia. Thanks so much for joining us. Let's take a look at what's moving in the early going here in Australia. BHP, we heard from a little bit earlier, kind of flat right now. The world's biggest miner saying iron ore output rose 2% in the first quarter. It's retaining its full-year guidance. In fact, production was up among all of the major commodities in its portfolio. CEO Mike Henry, though, of course, keeping a close eye on China. He says the stimulus out of there likely to focus on relieving local debt, stabilising the property market, bolstering business confidence as well. We heard from Santos earlier as well, out with its production report. Some pretty reasonable gains there for the gas producer as well, up about 0.75%. Treasury Wine, also one of the standouts in the early going. Also watching uranium stocks in Australia as well. This is after Alphabet's Google sees nuclear power as a key part of its strategy to get around-the-clock clean energy to operate AI facilities. Of course, artificial intelligence, very energy hungry. Those remarks, enough to send Australian uranium stocks surging this morning. We've got Paladin up 10%, Deep Yellow up almost 13%. Still to come on the Asia Trades, we'll be joined by the co-founder of Good-Edi, one of Bloomberg's new economy catalysts. And we'll talk market strategy with Principal Asset Management, plus an exclusive on the AI outlook with AMD's Chief Technology Officer. Much more ahead. This is Bloomberg.
Taking a look at some of the chip stocks, which of course have been leading those losses over the past couple of sessions and continue to do so in the Wall Street session overnight. We saw that rotation away from mega caps and into small caps. Of course, also being influenced by key US lawmakers pressing the Biden administration now to block Huawei suppliers from buying American chip-making gear, really escalating these efforts to prevent the sanctioned company from making more progress on manufacturing. This is the top Republican and Democrat on the House China Select Committee outlining those concerns. We're also seeing some sort of reaction when it comes to the ASML CEO talking about the slowness of the chip recovery extending well into 2025. Let's get some more on those earnings, though, and what we heard in the call. Our tech reporter, Animal Jewelers, is here. So what else could have stood out in terms of what investors are worried about?
Well, it's really just that two-speed recovery we're seeing in semiconductors, and we've been sort of talking about it because it's been a pretty interesting week for ASML. We know that they released the results 24 hours early, so we had the market reaction, and then there was that anticipation, what will we hear from the CEO on that earnings call that came a day later. And he didn't really do that much to sort of ease investor concerns around the outlook for demand in particular, because you think about semiconductors, and of course we've been so focused on what's happening in the AI space, and that market has been so hot for chips, and we continue to see those strong demand signals. On the other hand, though, you've got the market for legacy chips, and they're ones that are older technology. They're used in things like consumer electronics, automotives, and that's still really mired in a slump. And because of that, the ASML CEO says that customers are putting off their orders even into 2026, and they're still kind of cautious on the outlook as well. And that was what led into that lower guidance for 2025 that you can see there. So they're now expecting sales of up to 35 billion euros, and that compares to around 40 billion euros previously.
What's the role of China for ASML as well? Because it's a huge market, but can't really sell into it to the degree they'd wish, perhaps.
Yeah, exactly. I mean, China has been the biggest market for ASML over the past 5 quarters, and even in the latest reading, it was still around 50% of sales. But to your point, I mean, we know that the White House has been pushing through these export restrictions. They've really affected the chip equipment manufacturers like ASML and Tokyo Electron in Japan. And because of that, ASML is going to be restricted from selling its most advanced technology into China moving forward. And so the ASML CEO says that into the future, you can expect it to maybe account for 20% of sales. That's a huge drop down from half. And then at the same time, you also saw Chinese companies front running these restrictions by placing those orders earlier and stockpiling as well.
TSMC is one of the biggest customers for ASML, so what are we watching for when their numbers are released?
Yeah, it's going to be really interesting to watch, and these results due later. I mean, we've got sort of a Bloomberg intelligence piece out saying it's either going to ease or it's going to allay these fears, but or rather add to them. But the question really around TSMC in particular is going to be extra interesting to watch because, as you said, it is the biggest customer. It's also about how it's using the equipment, and our Bloomberg intelligence team is saying that big plunge in the third quarter bookings earnings could actually end up being something that's positive for TSMC in the medium term. And that's because it could actually give TSMC a little bit of breathing room in terms of competitive pressures. If less companies want its machinery, that means that TSMC can also have sort of more time to push out its orders, and they're not looking to go to other fabricators. At the same time, TSMC actually could be getting better at using ASML's most advanced machinery. This is the EUV machines that are crucial for AI chips. And again, that could lead to less investment into its machines, ASML's machines as well, into the future. So certainly something to watch. We've already had, of course, the headline figure coming through for TSMC. It was a strong result, but we want to get more on that outlook for demand and really what it signals for the broader market later.
All right, Annabelle Drewl is there. And staying on chip supply chains, key US lawmakers are pressing the Biden administration to block Huawei suppliers from buying American chip-making gear. The top Republican and Democrat on the House China Select Committee outlined their concerns in a letter. They point to some Chinese firms, including Suishore Technology, as likely members of Huawei's clandestine network. That's based on Bloomberg reporting. Haidi.
Well, still ahead, Paul, we're going to be hearing from AMD's Chief Technology Officer and EVP, Mark Papermaster, on the firm's outlook and how they're working to gain market share from Nvidia. This is Bloomberg.
Time for morning calls ahead of the Asia trading day. Morgan Stanley is cutting Chinese consumer discretionary stocks to underweight from equal weight. That's due to near-term uncertainty around Beijing's policy pivot and the US elections. Strategists see a lack of details on consumption, targeted stimulus, and uncertainty around the scale and timing of Beijing's fiscal expansion.
Goldman sees the S&P 500, extending its rally into the final months of the year. The bank's trading desk estimates that the benchmark can finish 2024 at the 6,270 level, adding that median returns are even higher in election. Suggest returns from mid-October until the end of the year can top 7%. They say that the sentiment has really shifted after gains in US stocks compelled fund managers to join in on the buying. Take a look at what we're watching in terms of the big US banks. Of course, this is sort of front and centre for earnings this week. We're seeing broad upside, and certainly that outperformance being seen in Morgan Stanley, up 6.5% by the end of the session, and slightly more modest gains from the likes of JP Morgan Chase. We did get some reporting that there were 3 JP Morgan CLO bankers that are leaving the firm to join SMBC. So we'll be watching some of those financials, given that we've seen, at least in Australia, previous session, financials really falling. But we have also seen some pretty good numbers out of smaller banks as well in terms of joining the big players for that earnings bonanza, Paul.
Well, we spoke with Morgan Stanley CEO after the bank reported its latest earnings, and we asked Ted Pick for his view on how investors are weighing election risks.
I think you have a number of investors that are actually just sort of continuing to plow forward on the view that the economy is in pretty good shape. And that consumers and corporates are in great shape, so that when there is an election outcome, once there's a sense for whether new policy will actually get affected, then they can have a reaction, and obviously that also then brings into question what monetary policy will look like. I think that our job is just to stay close to clients and to make sure our infrastructure is fit for purpose. So we do run tabletops to make sure that not just that we can help offer solutions to client functionality, but also that we have our act together internally. Even after the election, is there a sense of which party at this juncture is better for the stock market? Do you have a view? No, I don't. I really don't, because I don't know that we can imagine what the combinations will be, what the mandate will be, and what the policy action will actually be coming off of what's been said during the campaigns. What I do know is that the economy continues to be in pretty good shape, and that gives any new administration some tailwinds. But of course, they need to also continue to imagine where we are in the election cycle, and they also have to pay attention to deficits and national debt and all the things you've been talking about. There's the election itself, the vote, and then there's the moment till the vote is certified. Do you expect uncertainty to clear up quickly, or do you think it will last for a while? I know what I'm hoping for is what we all hope for, which is that the election is a certain outcome, and then we just go about getting a sense for what policy is. If there's uncertainty, that could go on for a bit of time, but markets tend to be reasonably sanguine about that kind of uncertainty for a number of days. There could be some jittery behavior, but assuming we know where we're going, the markets should align in due course.
You know, another uncertainty is capital rules around the big banks. The U.S. is mulling revised capital rules with lower capital requirements than initially put forward. How do you feel about the direction of travel?
I feel like the direction of travel has been constructive. We are carrying a capital buffer, as you know, about 160 basis points. We continue to carry that kind of buffer because it's an uncertainty that affects Morgan Stanley. And you know, if I think about the three pillars of things that I care about, Sonali, at this place, I care about a strategy, which is to raise, manage, and allocate capital for individuals and institutions. I care about our culture, which is one of rigor and humility and partnership. And I care about financial strength, capital, and liquidity. So whatever the, we'll call it vicissitudes of the discussion going into the election, I think it's probably the case that we're not going to have resolution on this until after the election. But I think the industry has made its case on where some real modifications should be made. And I think the regulator is largely listening, and we'll have to see how that plays out coming out of the election.
And that is Morgan Stanley CEO Ted Pick speaking there with our colleague Sonali Basak. And of course, talking a lot about the volatility we've seen this year, and it sure is good for business, if nothing else, makes for a white knuckle ride. But amazing numbers for the banks in this quarter. Morgan Stanley there we just saw hitting a 4-year record. Revenue from trading is up 13%. I think that's the best year since the start of the Dodd-Frank era. And of course, you know where we're going with this, right? I mean, you'd think the traders would be expecting a pretty decent bonus.
You would think so. And, you know, to be fair, the banks were doing quite well, right? Even the laggards at this point, when it comes to what we've seen in the numbers, have come in above expectations there. You know, Bank of America, for example, you know, maybe expectations were set a little bit lower there, but still has come in impressive. And we've seen, as you mentioned, when it comes to how to cash in on this windfall if you're a trader or a banker when bonus season comes around. JP Morgan Chase boosting costs tied to pay by 9% across its commercial and iBanking division for the first 9 months of the year. Goldman, firm-wide comp expenses rose by the same amount. MS lifting the figure for its Wall Street unit by 4%. So these biggest banks for sure are on track to post their best trading year since the onset of Dodd-Frank, as you mentioned. How that's going to sort of play out, given that really clamped down on the swashbuckling instincts on Wall Street. It really spelt the end to these outsized paydays. And do we see that kind of seeing a little bit of a return? We heard from Ted Pick saying that firms like this are kind of putting more distance between them and smaller rivals when it comes to the element of, you know, how much of these bonuses go into the cost of running a business. So we will be watching out to see how those fortunes might be, you know, trending for the better for these traders. More ahead on the Asia trade. This is Bloomberg.
Billionaire investor Stanley Druckenmiller says markets are pricing in a Donald Trump victory ahead of next month's US presidential election. But he told us exclusively that he won't be backing the Republican contender or his Democratic rival Kamala Harris.
I can't see myself voting for either one of them, so it really doesn't matter who concerns me more. And I certainly would never support either one of them. I just think they're actually unified on some things like industrial policy. Both of them think apparently the government should have a major role in allocating capital, which I find, frankly, Sonali, bizarre. When I think back 10 or 15 years, I'm a reader of Tom Friedman and quite a good writer, and he was constantly pointing out how the Chinese model was potentially superior to the US model, talking about how nice their airports were and their roads and how they could target certain industries. Well, my long capitalist suspicions have been confirmed, and China's been, as we all know, a disaster with that model. But somehow, both parties, Republican and Democrats, have adopted industrial policy kind of throwing free market Reagan capitalism to the side. So the policies in terms of that I find equally bad. I find her policies much worse in terms of anti-business and regulation. But frankly, I grew up in America with a certain model of a president. George Washington, Thomas Jefferson, Ronald Reagan was one in my lifetime, where there was a certain dignity and behavior in the office. And I don't judge anyone who wants to vote for Trump. But for me, it's just a red line, so I'll probably write in someone when I go to the polls.
When you think about the policies Donald Trump has put forward, a day ago he said to Bloomberg that tariff is the most beautiful word in the dictionary. He's negated the idea that many economists believe that this could have many punitive impacts on the American consumer. How do you see it?
Well, I don't like tariffs. I just said I'm a free market capitalist. The only thing I'll say about Trump is he's a bit of a blowhard. So I don't know whether he's negotiating with our foreign adversaries and, frankly, with our foreign partners. I don't think it'll be the end of the world, but I am not in favor of tariffs. I don't like them at all.
Duquesne Family Office Chair and CEO Stanley Druckenmiller speaking exclusively with Bloomberg's Shanali Barsak. Some of the other stories that we're following this hour: Israel's military expanding strikes on Lebanon on Wednesday and says it killed a regional Hezbollah commander. Lebanese authorities say a separate Israeli strike killed a local mayor. Israeli warplanes also struck Beirut for the first time in almost a week, just hours after Lebanon's prime minister said the US had assured him attacks on the capital would ease. The US and 11 of its allies, including South Korea and Japan, have unveiled a new plan to monitor the enforcement of sanctions on North Korea. The announcement comes after Pyongyang blew up roads leading to the south. Earlier this year, Russia used its veto in the Security Council to trigger the end of monitoring by a United Nations panel. Bloomberg has learned that India's government is weighing risks that senior officials may face charges if a diplomatic rift with Canada worsens. Sources say New Delhi is considering scenarios including Canada shutting consulates and delaying visas for Indians. The dispute flared again this week after Prime Minister Justin Trudeau accused Indian diplomats of ties to criminal violence. As we continue to monitor the latest developments out of the Middle East, take a look at how we're trading when it comes to energy markets at the moment. This is a picture as we see oil edging higher as traders are weighing up those tensions as well as a supply glut, as well as these concerns over demand out of China. Some of that enthusiasm over the stimulus package has certainly been driving some gains for oil, but the uncertainty, Paul, as to whether the fiscal side is going to come through to play is starting to weigh.
Well, we've got some GDP data out on Friday, likely to show China's economy grew at its weakest pace in 6 quarters. For more on this, let's bring in our China correspondent, Min Lo in Hong Kong. So, Min, give us a preview of the activity data we're getting out tomorrow.
Yeah, the GDP number, the forecast for the third quarter is 4.5%. As you said, that is the weakest in 6 quarters. Quite concerning here, given that we have seen a slew of rather disappointing data over the past few weeks, especially when it comes to exports coming in at only 2.4%, suggesting that this rare bright spot in the economy has been kind of losing momentum. And inflation is another area where China has really been struggling to increase prices in a sustainable way. And we look at the forecast coming out tomorrow, industrial production and retail sales expected to pick up pace from the previous month, but property investments still deep in contraction, negative 10%. And that is why the Housing Ministry briefing later this morning will be key to watch. Now, the GDP year to date, even though third quarter numbers is expected to be weak, but because of stronger growth in the first half of the year, we are expecting that China will be able to hit 4.9% growth year to date so far. That puts it in line with the target for this year. And we know President Xi was just recently visiting Fujian province. He was reported by local media as urging local officials to make every effort to hit that growth target this year. And that's after we know the PBOC had unleashed this very powerful monetary stimulus. We're still waiting for more details when it comes to the fiscal side.
We have a joint briefing later on today at 10 a.m. local time by 5 ministries tackling the issue of housing. How are expectations being set going into this?
Yeah, I mean, if you look at the stock market yesterday, the index of Chinese property developers was up, I believe, some 12%, according to the Bloomberg index that tracks these developers. So expectations are high. We're hoping to get more details from the government on how exactly they're going to stop the decline in the property sector. That was the directive from the Politburo meeting that took place not too long ago. We're expecting to hear more details when it comes to perhaps more funding or financing to support the building of these unfinished homes, 48 million of them on the market. Our Bloomberg intelligence analyst crunched the number and said that 11 trillion yuan is needed to support that. So could we see an expansion of the white list of property developers project that could be earmarked for more funding, for example? The Ministry of Finance also announced that local government special bonds can be used to buy back unsold homes. So we want to hear more details around timeline, scale, targets in terms of how much of these homes do they want to buy back. So hopefully we'll get a little bit more of the mechanics that would be fleshed out later today.
Bloomberg's China correspondent Mimin Lo, and let's take a look at one of the China proxies, and particularly tied when it comes to the housing crisis, right, is what we're watching when it comes to miners, particularly iron ore miners. We've got some output updates as well. BHP iron ore output edging up as these supply glut concerns really continue to grow. The CEO, Mike Henry, seeing further fiscal stimulus from China being on the way. We're also seeing an update when it comes to iron ore production from BHP, saying output in the first quarter rose 2% from the year before. So all of this is really kind of coming as iron ore basically seeing this tide of new supply just as these China wobbles continue to preoccupy investors, right? Front and centre will be this housing briefing from the joint ministries today from Beijing. The thing is, we've already seen an extraordinary amount of restrictions being loosened across Tier 1 as well as other cities as well, and that's really not done a meaningful lot to boost confidence for home buyers or for home sellers, I should put it that way as well. We're also watching Treasury wines there up by about 3.5%, maintaining that full-year EBIT forecast and also reaching that pact to settle a class action that's been sort of on the books as well. So we're seeing some gains there. When it comes to that sort of China-related play, we're watching copper. That's seeing a rise after 2 days of declines. Still a lot on the line as we wait for this news conference in Beijing that's expected to perhaps flesh out some of the more of the approaches in tackling the property crisis, but perhaps not high in expectations for new measures. Take a look at the broader markets, though. We are seeing some pretty solid gains here, trading here in Sydney. The ASX 200 up by close to 1%. That US small cap rally in the US really driving the rotation out of mega caps and big tech. So some weakness again expected for those chip stocks there. The Russell 2000 US small cap index at the highest level since 2021. We're seeing Singapore Nikkei futures up by 0.6% there as well, after we did see some of wobbling when it comes to Japan stocks as well. Again, that tech-heavy element sending Japanese stocks lower in the previous session. S&P futures looking modestly lower at this point. More ahead on the Asia trade. This is Bloomberg.
The Bloomberg New Economy Catalysts class of 2024 has been released, featuring innovators with a genuine shot at changing the world for better. One company on the list is Good-Edi, an Australian firm tackling waste one cup of coffee at a time. And joining us now is co-founder Aniyo Rahebi. Aniyo, thanks for joining us. So you've developed an edible coffee cup. I mean, it really is too bad you're not here with us, because I'd like to try it, if not just for the comedy of eating a cup on set. But let's get the obvious question out of the way first. What is it made of, and how does it taste?
So Good-Edi is made from oats and grains. It's a combination of rye meal, oat bran, wheat bran, sugar, salt, oil, and water. So it's very simple ingredients, and it tastes like a waffle cone, but a bit less sweet.
Okay, and for anybody who's wondering, I understand it does hold its integrity for 8 hours, which is plenty of time to get through a cup of coffee, but you're obviously solving a problem here as well. Can you give us a sense of the scale of the issue around single-use plastic-lined coffee cups?
Absolutely. So in Australia, we love our coffee, but that creates 2.7 million coffee cups every day are used. That's 1 billion per year. And some of the stats says that this number has doubled or tripled after COVID. Globally, this number is 250 billion to 500 billion cups. A majority of these cups are lined with plastic, so they are not biodegradable or they are very difficult to be recycled, and unfortunately, majority of them end up in landfill. So we have created this solution to provide a very sustainable and waste-free option to this massive problem.
For this to be impactful, though, you want to be able to scale up pretty quickly and significantly. I think when we spoke to you in May last year, your team was churning out about 500 cups a day for clients across Australia. Can you give us an update on how that scale has perhaps increased?
So we are still very small manufacturing. Our capacity is still 500 cups per day. But we really want more and more customers or coffee chains, they come on board and support our solution, really embrace it that this has a potential and this can be a solution to this massive problem. So with that, we are really inviting the big coffee chains or small ones to really support us with this solution that we have created.
So from a business side, what do you need to be able to meaningfully scale up? Because there was also a lot of conversation about international expansion.
So since last year, we have had few success to export our product to overseas, like US, New Zealand, a few other countries. But the whole concept of our product, we really want to be sustainable through the value chain. So we really don't want to ship all over the world. So ideally, we should have different plants across the world. The main challenge, obviously, is funding. And with this financial climate, it's quite difficult to raise funds for product-based startups. But we are working through it, and we are really focusing on having the right traction in the market to be able to convince the investors that this solution can be scalable and can expand across the world.
Yeah, can you give us some sort of idea about the cost per unit of making one of these? And even if you can't give us a specific number, how does it compare with the manufacture of a regular single-use coffee cup?
Absolutely. So as I said, our manufacturing or our plant is a very, very small capacity. At the moment, our cups is around $1 to outlets. And comparing to normal disposable cups, that cost varies depending on the material they are using and where they are importing it from. So it can be from 10 cents to 30 cents. So obviously, with a small capacity, our cost is not very competitive, but is a starting point, and majority of the time the consumer buy into it because because it is like a niche product and it's tasty and it can be a treat, and some they really want to support the initiative behind it and they really relate to it that this is a sustainable solution, is completely waste-free.
At scale, though, you know, sustainability kind of comes down to so many different factors, from economics, like Paul just pointed out, but also, you know, the ability for consistency to be achieved, for convenience for the end consumer, and the environmental life cycle too, right? Has there sort of been a life cycle assessment being done, and can you say with confidence that this is a product that, you know, can in all of these ways replace the other offerings that are already more sort of conventionally taken up by the market?
Sure. So the concept of edible packaging or edible container by itself can be completely a waste-free and sustainable option. So for our cups, we are making our cups from simple, natural ingredients, all locally sourced, and we are using a lot of bran, which is an upcycled or byproduct of flour making product. Majority of the time, this bran end up also in bin or landfill. So we are bringing it in to produce this simple solution. In terms of value chain or life cycle assessment, yes, we have done some study. So we source everything locally, we manufacture everything locally and distribute locally. When we did the comparison and the study, our cups has around 27% less carbon footprint comparing to normal disposable cups. So it is looking at the carbon footprint, but also the life cycle and end cycle, or what happens to the end product after it is consumed. So for our cups, if you eat it, completely waste-free. If you can compost it, and if it ends up in the bin, it breaks down naturally. You can even plant it. So there are a few options that consumers can have a very sustainable approach to finish this product or they use it.
Aniyo, really great to have you with us. Aniyo Rahebi, who's the co-founder of Good-Edi. Well, you can catch up with our past interviews or watch us live on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions that we talk about. You can join in on the conversation too by sending us instant messages during our shows. All of this is for Bloomberg subscribers only, though. Do check it out. It's at TV Go. This is Bloomberg.
Getting some breaking news out of Japan. It is the trade numbers for the month of September, and a bit of a downside surprise here. Exports contracting 1.7%. The expectation was for a modest 0.9% expansion. Imports also expanded slower than expected, 2.1%. The expectation was for a 2.8% expansion there. So both a downside surprise for exports and imports. The trade balance, meanwhile, a deficit of 294 billion yen. The yen, meanwhile, that's pretty stable at the moment, still pretty weak, 149.61. So a bit of a downside surprise there for Japan's September trade numbers, Haidi.
Take a look at one sector that we're watching very closely, which are the big miners. And of course, part of that is the big China story ahead of the property briefing that we're expecting from the five joint ministries today. But take a look at how we're trading. BHP Group is seeing a little bit of a downside there alongside Rio Tinto, despite Rio's earnings coming through pretty solid. Production, though, is really kind of the main focus at this point. BHP's iron ore production in the first quarter edging up just 2%. We're seeing that similar trend across a number of the producers, and that coming as the supply glut and the China demand story continues to weigh. Let's get some more on the outlook when it comes to the Australian miners. Our Bloomberg intelligence analyst Mason Crofts joins us now for more. So high production for BHP, we're seeing that as a broader trend. So what's going on? And it's kind of awkward timing given all of the uncertainties.
Yes, I suppose we did see a relatively decent production number from BHP. So iron ore was up a couple of percent to 64.6 million tonnes. And then copper up almost 4% to 476. So they are on track for their production numbers. The challenge that they have really is going to be around pricing. We did have a pretty strong run-up in the iron ore price. A lot of excitement about the Chinese stimulus and how that's going to play out. From our perspective, we're not quite as positive. We think even though the stimulus is a good sign and a good start, a lot of it's likely to flow through to the financial sector, and it may not be quite enough to get through to that really strong steel demand, which is what you're going to need for the iron ore price to stay up above $90, which is what's required for them to hit their fiscal 25 EBITDA consensus.
All right, so let's unpack that price expectation a little bit more. What's the longer term trend for not just the iron ore price, but the copper one as well?
So we're overall more positive on copper than iron ore over the medium to long term. The challenge that happens with iron ore is, so firstly, it's reliant on steel and primarily steel from China. China has a lot of fundamental issues, and with something like steel, you're going to need either a recovery in the property sector or pretty strong infrastructure spending. And the type of stimulus we're seeing is not exactly the right type necessarily to what we're going to need. Copper, you do have the pretty strong tailwind from the electric vehicle sector. And while over the next few years there are some challenges due to additional supply, we would expect from maybe fiscal 2028, there really just isn't enough copper projects coming through to supply that, and we are looking at pretty strong price growth from that time onwards.
What about valuations? Because we've seen BHP stage a pretty strong recovery. So is that just sort of on point?
Well, yeah, it's up over 10%, but I would suggest that when the valuation we've looked at, the current pricing for BHP is probably only looking at a iron ore price just over $80. So it doesn't look, from that perspective, it doesn't look overly out of line with the market pricing.
All right, Bloomberg Intelligence analyst Mohsin Crofts there. Let's get the latest from the corporate front. Star Entertainment has been allowed to keep running its flagship Sydney casino under government supervision. The embattled company was hit with a $10 million fine after a series of governance and cultural failings. A long-awaited financial update last month showed Star needs to raise even more capital and trading conditions are deteriorating. The stock has slumped about 50% this year. Hyundai's India IPO has demand for 42% of almost 100 million shares as of the second day of sales. Hyundai hopes to raise up to $3.3 billion. That would be the country's biggest ever listing. In the past, some of India's biggest IPOs have struggled on listing, and their tepid performance has also weighed on broader markets.
Take a look at how we're tracking as we see Asian markets set to advance. That US small cap rally rotating away from mega caps. The small caps gauge really trading at the highest since about 2021. We are seeing that focus on miners, as we've been mentioning, a little bit of a sort of a disparate performance that we're seeing there. Australian stocks are up by close to 1% at this point. Nikkei futures also looking like we'll see a bit of a recovery after yesterday's chip-driven sell-off. The market opens in Seoul and Tokyo next.
This is the Asia Trade. We're counting down to Asia's major market opens, and we had a better day for US markets. Financials, small caps doing well. Even tech had a better day as well. And we've got Stanley Druckenmiller saying also that the market's now pricing in a Trump win.
Yeah, it's quite interesting as we kind of inch ever closer to the election, right? And the question of whether politics, domestic politics, geopolitics is really going to sway the kind of broader trends that we're seeing with this market. But it is interesting that we are still seeing that sort of rotation out of mega caps. Whether it's going to be an easier day when it comes to Asia tech, given the thick and fast headlines and numbers that we're continuing to get. And TSMC, of course, one to watch today. Yeah, definitely. And it was a brutal day for Asia tech yesterday, particularly Tokyo Electron down 9%. We'll see if they recover to a degree today. We also had Renesas, SK Hynix, Samsung down in South Korea. As you mentioned, though, TSMC out later. And of course, the Dutch chip-making equipment manufacturer, ASML, a major client of them. So we're watching again for any sign of slowing demand for chips. But in the early going, we do have a reasonably positive start for the Nikkei there, better by 0.1%. The Topic's also posting some modest gains, perhaps though a function of that enduringly weak yen. 149.55 at the moment seems to be parked just below 150. Let's take a look at how we're doing in South Korea. Meanwhile, the Kospi also getting off to a reasonably positive start, better by about 0.5%. And that tech-heavy Kosdaq index as well, also rebounding. This is very much in line with the modest tech recovery that we saw in the US, Haidi. Yeah, we are watching local jobs reports, that data out from Australia, expected later today, and that's really going to have implications when it comes to the direction of the Aussie dollar. We heard from SocGen saying that the Aussie dollar is a currency most at risk, I should rephrase that, within that G10 space in the case of a Trump victory. Lots of implications when it comes to the exposure to China, potential tariffs. Of course, the US dollar would then benefit. So watching for a potential further slide in the Aussie, particularly if that jobs number continues to come through softer. We're already close to erasing that rally last month. Took it to the highest since, of course, February 2023. That we could see that further unwinding depending on what we get from the labour market data today. When it comes to broader equities, though, it is looking like a pretty high trading sort of day. Australian stocks are really advancing on the back of gains in uranium miners in particular. Financials are also staging a recovery, watching the iron ore miners as the results have been sort of more or less reasonable, but that upping when it comes to production numbers, this as the risk of that supply glut continues to weigh. We'll be watching for that China Housing Ministry briefing and the joint briefing by 5 ministries to see whether we see further sort of announcements as to easing for the broader sector and whether that can make a difference to the property glut and the languishing situation that we continue to see there. Tracking treasuries as well as Australian bonds edging higher before that jobs data. We're watching a Kiwi auction as well as an auction over in Japan of Japanese government bonds as well. Let's bring in for some views out of Hong Kong is Todd Jablonski, who's the Global Head of Multi-Asset and Quant at Principal Asset Management. Todd, great to have you with us. So I will start with you on China. Of course, another day, another briefing and another risk for investors to potentially be disappointed in what's announced or what isn't announced. I do wonder sort of how optimistic you are when it comes to either direct or indirect investing exposure to China based on the stimulus that we've had announced so far.
Well, it's been interesting to watch this steady drip of positive stimulus come out of China, both on the monetary side and on the fiscal side. And we're optimistic that, in fact, policy will be a big part of the ultimate solution to re-stimulating the world's second largest economy. But today, we find more attractive opportunities in other spots in emerging markets. We're overweight in India. We are overweight in Taiwan. We are underweight on China as we see better investment opportunities in other pockets of the EM complex.
Where do you see more interest across EM? Because India, of course, has been a market darling, but it's pricey, right? What are you looking at across the region that's sort of compelling right now?
Well, I think I would start with India. It was notable that before COVID, pre-COVID, Chinese and Indian equity markets tended to move in tandem. The correlation was pretty high. Now, notably, as those two nations chose different paths out of the COVID, you began to see a divergence in performance. You began to see a lowering of the correlation. So indeed, I think they make actually a bit of a strong pair. I mean, they're the two leading markets across emerging markets. We do prefer India because of the momentum. We have achieved greater than a 40% US dollar return in India over the last 12 months. And we think that positive momentum can continue. The earnings look strong. The sales expectations look strong. And I would highlight that again, that the dividend that comes from the positive demographics of China, the lower cost of labor, those are some of the competitive advantages that we see driving investors continually towards that Indian overweight. But to be clear, I would not encourage investors to remain underweight China for too long. The world's second largest economy can produce outsized gains in a short period of time. We saw that on some of the policy announcements. So I encourage investors to watch carefully as policy guides China forward.
Policy's not cheap, though. We have seen China government debt rising. In fact, the growth we're seeing in China is almost entirely a result of government debt. I mean, do you feel policymakers are getting bang for their buck, and are you concerned about these rising debt levels?
Well, debt's become a feature around both developed markets and emerging markets. I noticed this has taken place, again, not just in sort of the EM space, but certainly across the U.S., where you've had a lot of concern about the rising deficit. Now, notably, yes, debt can be used effectively to stimulate economic activity. Certainly, you don't want to put it towards disappointing or inefficient uses of capital. But no doubt debt plays a role. And where, yes, rates have come up quite a bit from their previous lows, but on an absolute level, relative to some of the longer-term trajectories, interest rates are still attractive enough that there are enough projects that make sense, enough funding opportunities for additional growth, that we think the additional debt burden can continue. And in fact, at this point, it doesn't look like a threat to the continued economic pace of development.
Well, you're there in Hong Kong at the moment. Principal Asset Management's got its annual APAC Summit. What are the themes you expect to be dominating this year?
Well, some of the items that we're talking about with investors really are around the slowing pace of the global economy. You're seeing weak labor data, in particular in the U.S., challenging some assumptions. Now, our base case at Principal Asset Management is that we can indeed achieve a soft landing, and that is our base case. And within that soft landing, that gives opportunity for risk assets to continue to perform. We're still overweight mega cap technology in our diversified multi-asset portfolios. I know they've been on a big run, and even though the valuations are high, I think that mega cap tech group can play as much defense as it does offense. So even as the economy slows, we think we can yet avoid recession, and there's room for equities to perform, as well as credit. There's carry and income potential in investment-grade corporate bonds, as well as preferred securities. In fact, I kind of like the short end of the curve for investment-grade corporates, preferreds, a way to generate income. And on the long end of the curve, if you're looking long duration, I do highlight that 30-year treasuries, long sovereigns, boons in Europe are a nice hedge to your portfolio, just in case we do get an unexpected shock to the financial system.
All right, Todd Jablonski, Global Head of Multi-Asset and Quant at Principal Asset Management. Let's take a look at what's moving in the early going in Tokyo and also Korea. Samsung Electronics rebounding yesterday. It lost about 2.4% yesterday. It's rebounding this morning, beg your pardon, higher by a third of 1%. SK Hynix also recovering some of those losses that we saw on Wednesday. Tokyo Electron, though, continuing to keep on digging. Had an awful day yesterday, down more than 9%, and this was after ASML posted some rather disappointing earnings. But the tech space going to be very much in focus again today. TSMC going to be reporting results later out of Taiwan, so the market's going to be watching closely for any other signs of slowing demand for chips. Elsewhere, take a look at nuclear stocks. Different story here. We have heard from Google, or Alphabet's Google, saying nuclear power going to be a key part of its strategy to get round-the-clock clean energy to run AI facilities, because, of course, these are notoriously power-hungry. Earlier this week, Google announced its first investment in nuclear power, supporting development of a number of advanced small modular reactors, and we've got nuclear-related stocks performing very well in Japan at the moment. More to come on the Age of Trade. This is Bloomberg. A joint briefing by 5 Chinese ministries on housing policy set for later this morning could provide details on how policymakers will implement existing housing support. For more, let's bring in our China correspondent, Min Lo, in Hong Kong. So, Min, what are our expectations around this briefing later this morning?
Yeah, well, the developer stocks were rallying some 12% yesterday, but a few economists that I've been speaking to are saying that they're not expecting very new policies to be fleshed out later this morning, but it will be more of details around the mechanics of the implementation that could be announced later. So we know when it comes to the supply side, the PBOC had announced a number of measures, including allowing local government special bonds to be used to buy back unsold homes and idle land. So we want to hear a little bit more about the scale of that, the timeline, and the target in terms of how much existing housing inventory they want to clear out there. The PBOC had also increased their support in terms of that relending facility for state buying of unsold homes, increasing their funding proportion from 60% to 100%. We're looking out for specific measures when it comes to supporting the completion of homes that are sold but not yet finished. So will there be more funding when it comes to an expansion of the whitelist of developers projects that could be earmarked for more financing support? And on the demand side, the PBOC had already cut down payment ratios for second homes and mortgages for existing mortgage rates as well. So less room for maneuver there, but perhaps some tax incentives for housing transactions. That could be a positive development.
We're also getting, of course, GDP numbers and domestic activity data out a little bit later on this week as well, somewhat backward looking, but we'll be watching out for those. That was Bloomberg's China correspondent Min Min Lo there with us. And let's bring in now for a little bit more context in terms of what we're expecting from this property briefing. Our China show co-anchor David Ingles has more on what to watch ahead of this joint briefing by 5 ministries. And of course, we're managing our expectations ahead of this, this announcement, David.
Yeah, we were doing some simple math, Heidi. It's a briefing every 2 or 3 or 4 days, so it's almost a regular cadence of expectations going up, and depending on what they say, maybe going down or even up even further. I like the way you phrase that, because we are going into data week. That's tomorrow, and what we'll be getting will be a reminder, really, of why we're here. Right? At some point, the rally was going to bump into either soft or very soft economic and earnings numbers coming through. The reason I say that is, going into this briefing today, while the equity markets have somewhat stalled in China, where we are seeing the rally continue, is in junk bonds, in dollar bonds, for example. I'll give you a good example of that, of course. So here's the rally. This is a daily change in this group of bonds, for example. There's the pullback post the holiday. That's where we are while the equity markets are consolidating. In fact, at these levels, we're nearing 89 cents on an average price for these bonds. That's point number one. In other words, expectations are somewhat optimistic and high, I guess, going into the specific housing market briefing. That's number one. Number two is and come back in a big way with confidence, because as you can see, this is a chart that shows mortgage growth has effectively come after almost a drop in the rate of change almost every quarter up until where we are right now, almost up to a standstill, right? So people are not taking money out despite how rates are already at quite some low levels. So the single most important chart, in my opinion, is this next one that's coming up on the Chinese economy, right? So we talk about supply side of money, which helps. It's insufficient, right? Because it's really the demand for money. There is some money available, right? So what this chart tracks is actually the pickup in the amount of savings parked in the banking system. So 2022 and 2023 are on your screens. These are the top 2 lines you see on your charts, on the chart. 16 trillion was added in 2023, 17 trillion in 2022. That's 34 over the last 2 years going into this year. The expectation was, once things start to stabilize, savings fall because people start to spend. That is not what happened. First 9 months of the year, savings rates went up 12 trillion. So I think in many ways, Paul, let me end on this, right? Is there a crisis? It's not the same crisis if your definition of a crisis is it's the non-existence of money. We know where the money is. It's just not being used. That's number one. Number two, though, is it's not really all about the supply of money, right? We talk to people anecdotally, and they say, we get calls for loans. We don't need the money. We don't need loans because we have the money. We're just not confident enough to spend it. Paul, I'll end with that.
All right, China show co-anchor David Ingles there. An abrupt shift in sentiment has undermined hopes among China stock bulls that the country's huge retail investor base could help drive a long-term rally. Asia Equities reporter Winnie Su joins us now. So, Winnie, retail investors are going from heroes to villains for equity markets. What's happening?
Right, so at the beginning, we all know that retail investors were a very big part of that rally as we saw record turnovers at record skills and record pace. But right now, they are part of the reasons that we're seeing so much volatility in the market, especially after that big drop last week. And we're hearing people on social media saying to close their security accounts and money shifting back to their bank accounts. So fund managers who are more long money focused, they're saying that it's been a crazy ride with the retail investors as they're selling and buying so fast and causing that volatility. And they're not really necessarily looking at fundamentals like valuations or earnings. So that's a risk in the market. However, some people who are more positive on this rally, including Goldman Sachs, are saying that there is still upsides in Chinese stocks, about a 10 or 15% of upside, because there's going to be more retail money coming into the market, and hence Goldman Sachs is still preferring A shares, small caps, over the H shares.
What is being seen as the next catalyst for the sustainability of this rally?
So retail money aside, as we talked about how volatile it can be, long-term investors are actually focusing more on earnings right now. And based on our Bloomberg data, we saw just the past week, actually, Chinese and Hong Kong stocks are seeing the most price target hikes, about 5% over the past month compared to some other bigger markets or their major peers. And that's showing that we're seeing some re-rating in terms of valuation, but also more positive views on the earnings forecast. And investors we talked to, including Man Group, said that they are seeing the earnings forecast slow down, and that has not yet been priced into the market. So with that, it can potentially provide a second leg for this rally to sustain. And other investors saying that, while we're seeing the earnings having bottomed, the question here is if it's going to recover in a V shape or a U shape. But most people say that it's going to be gradual as we see if policies are actually going to deliver. So watching out some of the key catalysts coming up, including the key meetings, the MPC and the Politburo, and also the macro data that's going to come out, including the retail numbers and also the property sales numbers. So these will potentially provide more hints if fundamentals are looking to return or recover.
Well, volatility seems to be the watchword at the moment ahead of the trading session. How are we looking at today's market?
Right, volatility is still going to remain throughout the session today, especially as we watch the briefing by the Housing Ministry today. So that would be one key element. However, most people, as we saw just yesterday, how it impacted the property sector, but not too much of the rest of the market. The overall excitement is not too big. It might provide some support for that specific sector, but overall sentiment, people are still focusing on if the government can really deliver that trillions of yuan of fiscal support. So not too much excitement, and we're watching if the CSI 300 today is actually going to head into correction.
Asia Equities reporter Winnie Su there. More ahead on the Asia trade. This is Bloomberg.
Billionaire investor Stan Druckenmiller says markets are pricing in a Donald Trump victory ahead of next month's US presidential election. But he told us exclusively that he won't be backing the Republican contender or his Democratic rival, Kamala Harris.
I can't see myself voting for either one of them, so it really doesn't matter who concerns me more. And I certainly would never support either one of them. I just think they're actually unified on some things like industrial policy. Both of them think apparently the government should have a major role in allocating capital, which I find, frankly, chenally bizarre. When I think back 10 or 15 years, I'm a reader of Tom Friedman and quite a good writer, and he was constantly pointing out how the Chinese model was potentially superior to the US model, talking about how nice their airports were and their roads and how they could target certain industries. Well, my long capitalist suspicions have been confirmed, and China's been, as we all know, a disaster with that model. But somehow, both parties, Republican and Democrats, have adopted industrial policy, kind of throwing free market Reagan capitalism to the side. So the policies, in terms of that, I find equally bad. I find her policies much worse in terms of anti-business and regulation. But frankly, I grew up in America with a certain model of a president. George Washington, Thomas Jefferson, Ronald Reagan was one in my lifetime, where there was a certain dignity and behavior in the office. And I don't judge anyone who wants to vote for Trump. But for me, it's just a red line, so I'll probably write in someone when I go to the polls.
when you think about the policies Donald Trump has put forward, a day ago, he said to Bloomberg that tariff is the most beautiful word in the dictionary. He's negated the idea that many economists believe that this could have many punitive impacts on the American consumer. How do you see it?
Well, I don't like tariffs. I just said I'm a free market capitalist. The only thing I'll say about Trump is he's a bit of a blowhard. So I don't know whether he's negotiating with our foreign adversaries and, frankly, with our foreign partners. I don't think it'll be the end of the world, but I am not in favor of tariffs. I don't like them at all.
Custody Family Office Chair and CEO Stanley Druckenmiller there speaking exclusively with Bloomberg's Shonali Basak. Let's take a look at how we're setting up ahead of the start of trading in Europe this Thursday morning. We are seeing futures trading like this, largely to the upside, tracking the gains that we've seen on Wall Street and so far early in the Asian session as well. Euro Stoxx 50 futures up by about 0.25%. A little bit of upside there being seen in German DAX futures. Watching though when it comes to the outperformance in particular of stocks in Spain. That's one that we've seen really that outperformance being extended. We're also watching for a couple of key data points today. UK CPI inflation coming through. That headline number expected to have eased in September to 1.8%. We're also watching broader euro area final CPI inflation as well, also likely to follow that trend of underlying cost pressures easing. But of course, the big one to watch for is also the ECB rate decision. Will almost certainly reduce that main policy rate by 25 bits at this meeting. That case for taking action has actually really only increased since the last meeting, given even the more hawkish members of the Governing Council seem to have acknowledged that. So watching also if we see any kind of semblance of recovery in this session from luxury stocks likes of LVMH and chip stocks like ASML that really struggled in the previous session. This is Bloomberg. We are getting breaking news when it comes to trade numbers out of Singapore at the moment. Electronics exports splitting that out, seeing a gain of 4%. We are seeing that quite a slowdown from the previous reading of 35.1% there. Non-oil domestic exports on a year-on-year basis, that headline number coming in at 2.7%. That is softer than expectations of 9.1%. And a further slowdown that we've seen from that over 10% gain in the previous month. If you take a look at the seasonally adjusted month-on-month number, that is a gain of just over 1%. Again, missing expectations there. When you take a look at some of the drivers that we've seen for pretty solid Singapore economic growth more broadly, that solid picture when it comes to trade and exports has really been one of those components, but we are starting to see some of that slowdown. Pharmaceuticals is really sort of one of the very sort of volatile elements, and we saw that at a gain of 35% and quite significantly different to what was expected, Paul.
We just got some breaking news here in Australia as well. It is the jobs numbers for September, and the labour market in Australia proving very resilient. The unemployment rate holding steady at 4.1%. This is after the August number was also revised to 4.1%. 64,100 jobs added in the period. The participation rate rose as well. We're seeing the Aussie dollar tick up a little bit here. So we did have markets pricing in the RBA making its first rate cut in February. Based on these numbers, no rush. We do have the CPI numbers coming down as well. We'll get data on that at the end of October.
Yeah, Paul, take a look at that big move in the Aussie dollar, right? As we had sort of earlier speculation if there was softness in those labour market numbers that would see that further sort of consolidation of the unwinding of the long Aussie trade, but that's not the case when we're seeing that sort of rebound, given that the rally that we've seen in the Aussie has kind of been backtracking. We'd almost kind of undone most of that rally. But SocGen also coming through and saying that they see the Aussie as being potentially the most at risk within that G10 space if we see a Trump victory. Of course, that China exposure, tariff exposure, very much at play there. But the Aussie dollar seeing that rebound now. We're at the highest level since February 2023 last month. We're seeing clawing back some of the unwinding that we've seen at the moment. Markets are still pricing for the RBA to make the first rate cut in February. About a 40% chance that Governor Bullock pivots to easing in December. We're also watching tech stocks and IT stocks largely weaker across this Asia session, broader gains that we're seeing that drop for most of the big tech names on Wall Street after the head of the Dutch chip equipment giant ASML delivered a sober outlook. Let's get more from our tech reporter, Annabelle Jewellers. What did we hear?
Well, it was the earnings call that followed the numbers that came 24 hours prematurely, but essentially it just sort of spelled a pretty grim outlook, really, for their equipment. It really talks to that sort of two-speed that we see in the semiconductor industry more generally. You've got that hotness around AI chips, but legacy chips are still not doing as well. Automotives, but the ASML CEO spoke about this sort of divergent theme in the earnings call. Take a listen.
We continue to view AI as a key driver of the industry recovery with potential upside. We see other segments recovering more slowly than anticipated. The recovery will extend well into 2025, which is leading to customer cautiousness and some push-outs in their investment.
So given that investment is being pushed out, as he said there, it does mean that they've lowered their guidance into next year. And really part of feeding into that equation is the story for China, because not only did we see China front-running those restrictions on the shipments of ASML technology to the mainland, we're also expecting China to just generally account for less of ASML sales moving forward. So around 50% down to around 20%. That's what they're saying is going to be that pace of normalization.
Well, we could see a bit more upheaval for tech stocks today. We're going to hear from one of ASML's biggest customers, TSMC. What are we expecting?
Yeah, that's right. It's certainly going to be sort of a make or break moment, perhaps, for the broader chip industry over the course of this week in trading. But TSMC has already reported sort of the headline figure. It came in better than what economists or analysts had been expecting. But still, it's going to be really key on that guidance outlook. As you mentioned, yes, it is actually the biggest customer for ASML. And actually, what our Bloomberg intelligence team is saying that the plunge that we saw in third quarter bookings for ASML could actually be a positive for TSMC, because it could lower the competitive pressures on TSMC to keep producing the highest quality chips out there, or the most advanced. The other story or part of the equation is that TSMC could actually be getting better at using ASML's most advanced machinery. This is the EUV machines, and that's something else we'll be watching out for. What do we hear in terms of the guidance or the outlook for profitability, and also CapEx plans moving forward?
All right, Annabelle Jewellers there. Let's get to Singapore now for more on the semiconductor industry. Bloomberg Markets Asia anchor Linda Amin there with our next guest.
Well, Paul, it is about ASML, it is about TSMC, it's also about the U.S. mulling those moves, perhaps a cap on AI chips to some countries' lots. To delve deep into, exclusively joining us right now, Mark Papermaster, Executive Vice President and Chief Technology Officer at U.S. chip and devices producer AMD. Mark, good to have you with us in the Lion City.
That's Linda. Thanks for having me.
So it is a complicated picture for the chip industry right now, especially on the back of those tensions between the U.S. and China. The U.S. again mulling, capping AI chip exports to some countries. How are you looking at this?
Well, Haslinda, we're always looking, of course, at export controls, and we're always compliant with those export controls. And it's a dynamic situation. So what we do is we stay in close communication with the government controls. And frankly, we adjust our roadmap. We built in a flexibility of our chip designs to make sure that we can adjust to any market that we serve and become a product-oriented selling pattern that matches the export controls.
How much impact might such a move have, bearing in mind that the U.S. is already putting restrictions in more than 40 countries right now?
Well, as I say, it is a dynamic changing situation, but the demand for compute is so explosive. So what you're going to see from a market standpoint is broad growth across all the factors of computing. AI is growing in cloud, it's growing in the edge, it's growing in our personal devices. So export controls will adjust regionally, the type of computing devices that are sold into one market, but it will not change the macro.
So you're saying that there may be some redesigning of those chips so that it will still enable you to be selling and be competitive in those markets?
That's exactly correct. And we've built in our product planning that redesigning, that adjustment that we know that we will need as export controls may be changing.
We heard from ASML talking about the outlook for the chip industry, that lackluster performance, that recovery might just go deep into 2025. What are you looking at AMD? Are you experiencing the same kind of picture? I mean, we're talking about non-AI chips, though.
Yeah, what's interesting is when you look at AMD, we've really broadened our portfolio if you think about the last 5 years. And so we've gone from being primarily a consumer-oriented company a decade ago to now a majority of our revenue, which should transition this quarter, now coming from the data center. And so we are seeing actually strong growth in the data center across our x86 server, with our EPYC product line, across an incredible growth that we've had in AI with our data center GPU. And we're seeing now the signs of the rebound in our embedded industry, where our bookings are going up.
Can you quantify that for us? Strong growth in terms of numbers, double digit, how strong?
We're definitely double digit across our data center growth, and we're being announcing soon. We just closed our quarter, but if you look historically, we've been growing quarter over quarter, double digit on an annual basis.
We talk about exponential growth, exponential demand for AI chips. How sustainable is that?
Well, I think people sometimes look at that and say, hey, this is a fad. And how can this be sustainable? But what they fail to realize, if they make that statement, is that we're really at just the beginning. Think about it, the training of the models to be able to perform, very complex tasks within AI. I mean, asking very difficult questions and having a model that is trained to give you expert answers. That's all been around since just the last 2 years, since the advent of generative AI. That's what caused this huge inflection in demand for AI computing. So we're 2 years in, and we're now shifting from a bulk of that computing needs being in the training of those models to now running the AI applications. That's inferencing. And so as you start to see more applications, the analogy I'll give you is think about a smartphone. Smartphones came out and we said, wow, that is a really cool technology, like we said when we saw generative AI. But what happened when the application stores came out? It exploded. It became built in every facet of our lives. That is what you're seeing as more and more inferencing applications will come out in the cloud, in endpoint devices like the AI PCs. It will just become a necessity in our daily lives for enhancing our productivity.
And now everybody wants to be a chip player, the likes of India, the likes of Malaysia.
That's right.
In Asia, who's leading the charge?
Well, actually, we're seeing a broad focus across the region. And we're very excited at AMD to have 9 locations in India. In fact, almost half of our employee base is in the Asia region. We're expanding in the region, and so we're seeing strong growth across India, Singapore,
but Mark,
Malaysia.
how realistic is India's chip ambition? Some say that it is really late in the game. How does it accelerate that?
What's interesting is the commitment made by the government. I was actually at Prime Minister Modi's Semicon 2023. Just in August of last year, we announced a $400 million growth investment in India. We're actually celebrating our 20th anniversary in India next month and entering phase 2 of that expansion. What I saw at that conference was real commitment to growth of the semiconductor industry, government investments to bring in manufacturing to go along with the strong design capabilities already there, like our presence.
Of course,
from
it's
AMD.
not just AMD that wants a piece of the pie in India. Nvidia is also there. How do you look at that competition? I mean, you've done some acquisitions recently. And most recently, I think it was a $5 billion investment. I'm just wondering, how close are you to making a dent on Nvidia's dominance?
Well, it's a great question. I mean, we live in a very, very competitive industry. You look at our competition in x86. We set up a roadmap to bring a leadership capability, and now we have over a third of the x86 server market. So now you shift to data center GPU. We've competed for decades with Nvidia in graphics computing, and we set our sights years ago to be competitive in the data center GPU. We started first in high-performance computing. We have the world's largest supercomputer at Oak Ridge National Lab in Tennessee. And we have many supercomputing installations across the world.
Can you quantify, though, how close you are to catching up?
Well, here's the way to think about it. We started in AI, building on that base in HPC with, I'll say some millions of revenue at the end of last year. So think about it as a very small starting point in data center GPU. Fastest growth of a new product in AMD history by far. We're projecting over $4.5 billion in revenue in data center GPU this year.
Some suggesting that for you to actually play catch up is to get about 20% of the AI chip market. When do you think you'll get there? Because they say that once you get there, you'll become, a real second player.
Well, I believe our growth will be much faster than what you saw on that CPU server trend that I just described. And there's a simple reason for that. You look at what companies are doing that fueled that growth to $4.5 billion this year. They're making strategic decisions, Haslinda. Hyperscalers and heads of enterprise infrastructure are deciding that they don't want to be locked in with one vendor in a proprietary approach, more like the mainframes of yesteryear. And so what they're looking for is choice, and they want a partner who's open. They're making strategic decisions to grow with AMD and have a platform that can be multi-vendor and that they can move to the vendor of choice, not be locked in.
Mark, before we let you go, you talk about how you're invested in data centers. It's sucking energy. We know that. And that is a big concern as the world tries to get to net zero. How are you looking at it, and how do you see that shaping the energy sector? Some say perhaps you can't get there without nuclear energy.
Well, you can see the recent news of Microsoft investing in a nuclear power plant. It's very clear that we will be energy gated to grow the necessary AI compute capacity if there's not innovation. And it will take all of us working together at AMD. We are driving massive energy efficiency into our chip designs. We have 157 of the top 500 green supercomputers in the world. We announced our next generation MI350 data center GPU will be 35 times more efficient per dollar per watt of energy than our existing data center GPUs that we're shipping today. And so it will take our industry designing more efficient chips, and it will take innovation in the energy industry to bring more effective sources to bear.
Mark, great having you here. Thank you very much for your time today. Mark Papermaster, Executive Vice President and Chief Technology Officer at AMD. Haidi, handing it back to you.
Great conversation then, and we'll have more on tech coming up on Bloomberg Originals. Momentum with Haslinda Amin takes you to the frontiers of innovation, uncovering the groundbreaking ideas and inspiring people shaping our future. That is streaming now on Bloomberg Originals. You can catch it at 6:30 a.m. Friday morning on Hong Kong time here on Bloomberg Television. More ahead. This is Bloomberg. Taking a look at how we're trending across commodities, and of course a lot really hinges on what we get from the joint ministries briefing. 5 ministries gathering together a little bit later on when it comes to more expectations for further policy measures to support the property market in China. We are seeing oil trending up by about 0.6%, just edging higher as traders continue to weigh these two aspects, Middle East risks as well as the supply glut. Supply glut woes are also putting some pressure when it comes to iron ore as well, with the latest production numbers out of the majors, 0.6% higher for iron ore at the moment. We are seeing copper also reversing those 2 days of declines ahead of the China housing briefing, also trading a little bit higher there. Well, Israel has stepped up airstrikes on Lebanon and says it's killed a Hezbollah commander in the country's south. Let's get more from our Bloomberg News desk editor, Jablonski. And this attack that we've seen on Beirut coming despite some assurances that Lebanon says that it had from the US.
Yes, that's right, Haidi. In addition to this attack, which the Israeli military says did kill this Hezbollah official, Lebanese officials are saying that some of these strikes actually hit near civilian areas, that some members of the civil service were actually killed. We also did hear that there is an airstrike that hit Beirut that comes after the Prime Minister of Lebanon did receive some assurances that attacks would ease up in that area from Israel. And as you said, this really does kind of characterize how difficult it's been particularly for the U.S. as an ally of Israel to really kind of calm some of the fighting in this region, to stop some of these escalations. And of course, Heidi, all of this also coming as we're still waiting to see what kind of retaliatory strike Israel eventually makes on Iran. That is still something that we've obviously been looking at for the last couple of weeks. We still are waiting to see how significant of a retaliatory strike that ends up being.
And of course, it comes at a time when the US has also linked its ongoing supply of military equipment to Israel to humanitarian supplies into Gaza. Are we seeing any evidence of that bearing fruit?
So yes, Paul, there has been some some of that relief that has actually made it into Gaza, but not yet clear whether that's actually enough. Certainly, the U.S. obviously has been working for the past year to try to temper, some of the response that Israel has had against those attacks a year ago on October 7th. But the Gaza relief, now the latest bit of that's tied to the U.S.'s military support for Israel. This obviously all still happening as we await that retaliatory strike from Israel. The U.S. has been working to try to temper Israel's response again, on that being something that's targeting energy facilities, nuclear facilities into Iran. Not yet clear what Israel will ultimately do or if the U.S. is ultimately going to be successful in sort of reining in some of those actions.
All right, Bloomberg News Desk Editor Jill Desis there. We have more to come on the Asia trade. This is Bloomberg. Now let's get to the global race to make cheaper electric cars. That's the subject of today's Bloomberg Big Take, and it seems a clear winner is emerging in the shape of China's BYD, which is flooding foreign markets with affordable models and catching industry leaders off guard. EV supply chain reporter Danny Lee has the story and joins us now. So, Danny, why does BYD cause so much intrigue in America and beyond?
Yeah, so for Bloomberg, we have given BYD our deepest look yet in what this company means for the global auto industry. And so you see how it terrifies the likes of the global auto industry, how it causes much intrigue for Wall Street and for Washington here. And what we see now is BYD in around 20 countries, expanding to this year. It's in around 95 markets overall, and it is making inroads in key countries, mature auto markets like Brazil, Australia, and Thailand, and where it's already had this kind of success. When you step back and see how it could have success globally, that is the kind of thing that worries the global auto industry. And for the auto industry, they're trying to grapple with tariffs and trying to see if that tariffs basically could slow down BYD, frankly. And so for BYD, having this level of success internationally is a pretty bright spot given what it's been able to do in the China market. And with its success having a kind of wide range of products, its affordable lineup, and the technology, this has allowed them to sow the seeds to go from China to the rest of the world to try and take on a lot of the big global auto players. And its success also has to come down to the fact that it's been able to make big bets and early investments and not worry too much about shareholder value, because this shareholder value is now paying the dividends. And when you look at how the rest of the global auto industry are currently struggling with this EV transition, it causes shareholders worry. That's not been the case with BYD, and it's paying dividends now. And you can see how it's one of the most valuable auto players right now, only bested by Tesla and Toyota.
But there's so much pressure from these Western markets, right, when it comes to curbing its market share. You spoke to Stella Lee, who's one of their top execs. Did you get an idea of how they're kind of dealing with that and what their playbook is more broadly?
Yeah, I think the word to sum up from just speaking to Stella is this resilience, this mentality of just how it came to being and how it's been able to not have the government support in the very beginning, to how it's had to chase sales around the world, had to physically knock on the doors and knock down the doors of potential customers and suppliers in order to just get noticed. And so that kind of fighting spirit and mentality is something that I feel can translate into what it's trying to do today to navigate these choppy waters of geopolitics and tariffs, that things like these bigger barriers of today will not necessarily slow them down. It's in a lot of markets right now, but it will continue to pursue this kind of global expansion in order to just, show what its products are about and what it can do.
Our EV supply chain reporter Danny Lee there with the latest and taking a look at futures over the next hour or so, watching, of course, some of these chip-related shares, and TSMC bulls are looking to strong results to support the record high share price. One story that we're watching very closely in the hours ahead.